Ross Gerber went on the Schwab network today to make a bullish case on Tesla stock as well as interest rates and Fed policy over the next coming weeks and months. I think as a Tesla stock investor, you should hear out what Ross Gerber said today on the Schwab network. On top of that, which is more important in the short term, the data coming tomorrow is huge. Colossal in magnitude. If there is one data point this week that is going to cause the markets to fall a lot or really solidify this rally, it's the data coming out tomorrow with the unemployment rate and the non-farm payrolls. So I want to break that down, give you guys my estimates and opinions, and I hope you find some value out of this video.
And you got an inverted yield curve in a strong economy. Okay, that means the Fed isn't paying attention to the market. And so right now we have some of the biggest imbalances in banking and real estate that I have ever seen. And I don't know how that rectifies itself, but banks basically are in a horrible position thanks to the Fed. Homeowners, like if you have two kids and you're living in an apartment, you want to buy a house, good luck with that with 7.5% mortgages. So, they've really put a lot of pressure on certain industries while the rest of the economy, is doing fine. So it's a really arbitrary way to slow the economy. And it's working for sure. But, the Fed will have room to lower rates 50 basis points easily into next year or more. And that will give a lot of ammunition to stocks moving forward. And that's why I think people are buying stocks today is they're looking out over the next couple of years and know that this is the peak in rates.
Peak in rates, but as we just discussed there with Marta, a strong case that she would make many others, that peak doesn't equate to the reversal in rates that you're talking about, that the market has kept getting wrong. So where is that confidence? I mean, because you're buying these other companies because you like NVIDIA's AI breakthroughs, right? You like Tesla's breakthroughs in technology. I mean, you're an Apple guy, I feel like, normally, unless something's changed. I mean, if you're long these stocks, you got to have some hope in the consumer's buying ability. So how do we cut rates in an environment where a company like NVIDIA apparently is revolutionizing tech? I mean, won't that be good for the economy?
Well, it's good for the economy. It's bad for jobs because, every tech innovation, actually hurts jobs. So when you look at what AI really does is it eliminates an entire layer of sort of like middle management in a lot of ways. So AI productivity will have dramatic impact on communities like the legal community, associates and legal secretaries. These jobs are at risk thanks to AI. And so companies that have no debt like NVIDIA and Tesla are really in the driver's seat as they grow their cash flows. They have lots of leverage in their businesses and they have no debt, so the Fed doesn't really affect them. As far as the consumer is concerned, it's all about jobs and people have jobs. And the whole reason the Fed is bearish is because people have jobs and they're making more money, which is kind of a weird thing too, because I thought that was the goal of America, was like, capitalism is good, not God forbid people make money here in the United States, especially on the low and medium income earners are making more and more money. And this is great news. So I think we just interpret things differently. I look at this super core as a great thing that wages are going up 4% in America for people. And while inflation is less than that, that means their real buying power has been growing. And we're seeing those numbers in Vegas, like my holding MGM just reported a great month for gambling in Vegas, really strong numbers. Football season's about to start. The consumer's out. The consumer wants to live their life and enjoy their life. They all have jobs.
Sure, fair enough. Yeah.
So what we really need is the Fed to back off and let rates play out over the next 6 months, because there's a lot of these imbalances that will play out over the next 6 months, which will continue to put pressure on pricing. And then they've got this ammunition if and when the economy does slow to then lower rates. So they're really in a good position if they just stay where they are and just wait and see how the fall, plays itself out. But this reacceleration of inflation thesis is absurd to me.
Okay. Point noted. Let's talk Tesla for a sec while we got you for sure. The autopilot, Elon mode, pseudo autopilot, government is a little bit worried, Highway Traffic Safety Administration, etc. Is there a real limitation to this as a growth engine for the company or as a draw for the products if the government's going to try and push back on it this hard? How does it affect the case for owning Tesla and the case for them beating their peers selling cars?
Well, first of all, this whole Elon mode thing is way overblown. I don't know how to do that. I use full self-driving every day.
We know. We saw the video.
Yeah. And so, for me, full self-driving is making great leaps forward every couple weeks. It gets better and better and better. And we're getting to a point where the cars don't need you nagging it all the time. Quite frankly, it's really annoying because the car drives really fine. And, honestly, Tesla could do a better job probably communicating with the public about what's going on and the safety features. And this is what I've been, pushing them to do. Maybe they'll do that. But, the truth of the matter is I was stuck at my house yesterday all day because some truck driver crashed on PCH and the entire city was stuck in West LA because of one human. So let's be real. Humans are dying at 100 people a day on the road. And the sooner we get this technology out, the better off we will all be. So let's cut the nonsense with the NTHSB or whatever they're called.
All right. Ross, thanks for checking in with us as always. Appreciate the convo.
Yeah, thanks.
All right, you got it. Ross Gerber.
So I think Ross Gerber makes a really good point. The Fed has done enough. The Fed does not need to continue to raise rates. That would really be overkill, and any chance of a soft landing is just gone at that point because it's clear the economy is slowing down. I know a lot of people that work in restaurants, and every single one of them tell me it is very slow now. It was not this slow the last couple of months. It's normally not this slow every year, and it is dramatically slowed down. Maybe that's because people know student loan repayments start in October. That could have an impact on things, and that's going to suck about $15 billion a month out of the consumer. That was just extra spending money. So there's a lot of things that are already at play here, and Ross Gerber's making the argument the Fed does not need to raise rates again, and they probably will not raise rates again. And I think that's important in terms of Tesla stock, because Tesla is in a small category of the markets, as far as stocks on the market, that are specifically vulnerable to interest rates. And that's because the consumer that actually buys Tesla products, well, about 90% of consumers get loans for new vehicles. So every time the Fed raises rates, it puts more pressure on the consumer. And every time the Fed raises rates, it takes a whole group of people out of the markets that is no longer eligible to buy Tesla because of those interest rate payments. So Elon's made this point before. Even though Tesla's cut prices on their vehicles and they're not as high as where they were in 2021, the affordability has went down, right? Because people cannot afford to even buy Teslas at today's prices at a higher rate than they could when Teslas were much more expensive in 2021. So there is that aspect of it. That, when the Fed does start to cut rates, more people will be eligible to buy Teslas on that monthly payment. But also on a sheer kind of stock basis, Tesla's stock is hit a lot as interest rates go higher. And really, as interest rates go higher, the odds of a recession go higher. And that's why Tesla's stock is not in the $400, $500, or $600 range today. And Tesla stock is in the $260 range today because of interest rates, because of this fear of a recession at some point. Tesla's business itself since 2021 has more than doubled. Its actual revenue and bottom line profits have, well, maybe not bottom line profits. Everything is basically doubled. Besides profits, I think that's up like 75% or so since 2021. Just because their margins recently have come down. But the stock itself would be much higher today if interest rates did come down. So upon those actual rate cuts, as long as the Fed's not cutting rates because there's a problem in the economy, Tesla stock will start to do better. So Ross Gerbers making the argument that when you're at the highest point that rates are going to go, there's a lot of upside for stocks, especially stocks like Tesla that are sensitive to interest rates once the Fed does start to cut rates in 2024, and I agree with what Ross Gerber has to say. Now to the economic data. So this data is the biggest data report that we were going to get for this entire week, and I firmly expect the markets will move big off of this data. If this data comes in bad, well, we're going to have a problem. If it comes in too good, we're going to have a problem. You really want a fine line here when it comes down to these actual numbers, because any big rise in unemployment, well, that's recessionary, right? If unemployment rate were to actually fall, that would be great. That doesn't look very likely, though, based on where the estimates are, and we're going to take a look at that here in just a second. But when it comes to non-farm payrolls as well, you don't want to see a super high number, but you also don't want to see a super low number, because at that point, well, recession fears are back. The problem I have with tomorrow's data is the JOLTS job openings. We were expecting around 9.5 million job openings, and this data came out on Tuesday. The job openings came in at 8.8 million. That could be a precursor to say, hey, the job market is actually weakening quite a bit. So the jobs report might actually come in really low. And that's a problem. As I said, too low or too high is a problem. So the non-farm payrolls for August, we're expecting 170,000 job ads. Last month's rating was 180, last month's job rating was 187,000. The estimate is around 180,000, the actual forecast. Somewhere in the range of 170 to 180 is expected. If this number comes in under 100,000, the markets are probably not going to like that. The recession fears are probably going to take over. Again, anything above 220 or 230 is probably going to be seen as a negative thing for the markets. Now, what we have seen a couple times over the past year or so is you'll actually get a blowout non-farm payroll report, like 300,000 jobs, and the unemployment rate will actually go higher. And that really shouldn't happen, because how does that make sense? But it's a possibility for tomorrow as well, that we get a really good non-farm payroll report and the unemployment rate actually jumps. So the unemployment rate is expected at 3.5%. If we get 3.5%, that's great. If we get 3.4%, that's great, because the JOLTS job openings are falling, and the Fed has made it very clear to markets. The unemployment rate can stay low as long as the job openings come down. So job openings just came down by about 700,000 jobs last month, and this is the lowest job openings number we have seen since the beginning of 2021. So we're making progress there. So if the unemployment rate stays low, that's great. But if job openings are coming down because more people are unemployed, that's not good. And that's basically what the JOLTS job openings on Tuesday could be foreshadowing to us. It could be telling us that the unemployment rate is about to jump. Again, you're expecting 3.5%. Last month's rating was 3.5%. 3.6% would be okay in my opinion. Anything 3.7% or higher is a problem. If this rate comes out tomorrow at 3.8%, we have a big problem. Because anytime the unemployment rate has jumped from 3.5%, call it, to 4%, or 4% to 4.5%, anytime it's went up 0.5% in a short span, you have always seen a recession after that. So that is what the markets would focus on, would be a recession. Now, my personal estimates, based on kind of what I've seen in the economy over the past, couple of months, and this is only my opinion, I could be wrong here, the non-farm payroll report, I think, comes out in between 190,000 jobs. 100,000 and 90,000 jobs. So pretty dang low. The unemployment rate probably going to come in around 3.7%. They obviously round on this. So if it's higher than, 3.65, they're going to round to 3.7. If it's lower than 3.64, they round down to 3.6. So that's important to keep in mind as well, and that could also kind of sway the market based on what gets rounded here as far as the unemployment rate. But I do expect somewhere around 3.7% for the unemployment rate, and again, in between 90,000 and 100,000 job ads, much lower than the estimate. So it's kind of borderline, right? 3.7% unemployment, we've seen that before. We've seen that just back here in May, and we've seen that in October of 2022. We've seen that in August of 2022. So it's not breaking out to a new high based on what we've seen in the last year, but it would be at the highest point we've seen in the last year. So that's my expectation, and we have seen big jumps like this before, right? In April of 2023, we were at 3.4% unemployment, and then you jumped to 3.7%. In May. So we've seen big jumps before. So it's even possible we could jump to 3.8%. All in all, I do expect some pretty bad data tomorrow. And that could have a pretty negative effect on the markets. So that's what I have for you guys here in this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, get notified every time I make a trade, or anyone else in the group, you can come hedge out your portfolios. You don't have to sit on your hands and watch your portfolio die coming tomorrow if this data is bad. You can come join us, link down below in the description of this video. My name is Michael Tyler. Thank you for watching today, and I will see you in the next one.